The global silver market is experiencing a seismic shift that most investors haven't fully grasped yet. China, the world's third largest silver producer and historically a major exporter, has effectively frozen its silver exports, creating ripples across international markets that could fundamentally alter the landscape of precious metals investing and industrial supply chains. Since late 2023, China has dramatically curtailed silver exports through a combination of policy measures and strategic reserve building. What began as incremental restrictions has evolved into a near-total export freeze by 2025. The Chinese government hasn't issued an outright ban, but rather has employed a sophisticated array of bureaucratic hurdles, export licensing delays, and preferential domestic pricing that makes exporting silver economically unviable for Chinese producers. This quiet policy shift represents a calculated move by Beijing to secure strategic resources amid growing geopolitical tensions and technological competition. Silver's dual nature as both a monetary metal and critical industrial commodity makes it uniquely valuable in China's long-term strategic planning. Silver occupies a unique position in the global economy. Unlike gold, which serves primarily as a store of value and financial asset, silver is indispensable to modern technology. Solar panels, electric vehicles, 5G infrastructure, medical devices, and countless electronic components rely heavily on silver's unmatched electrical and thermal conductivity. The renewable energy transition has particularly amplified silver's importance. Each solar panel contains approximately 20 grams of silver, and with global solar installation capacity exploding, industrial silver demand has reached unprecedented levels. Electric vehicles require up to 3 times more silver than conventional cars, further straining supplies as EV adoption accelerates worldwide. China's silver production reached approximately 3,500 metric tons in 2024, yet exports that same year plummeted to less than 200 metric tons, down from over 1,800 metric tons in 2022. This represents an 89% collapse in Chinese silver exports within just 2 years. Global silver demand in 2024 exceeded 1.2 billion ounces, while mine supplies struggled to reach 850 million ounces, creating a structural deficit of roughly 350 million ounces. This marks the 4th consecutive year of supply deficits, but China's export freeze has transformed what was a manageable shortage into a potential crisis. Silver prices have responded accordingly. After languishing below $25 per ounce for much of 2023, prices surged past $30 in late 2024 and have continued climbing into early 2025. More importantly, the gold-to-silver ratio, which historically averages around 60.1, has compressed dramatically, suggesting silver remains undervalued relative to gold despite recent gains. The export freeze is forcing manufacturers worldwide to scramble for alternative sources and reconsider their supply chains. Western electronics manufacturers, particularly in Europe and North America, face increasingly difficult procurement challenges. Some have begun paying premiums of 15 to 20% above spot prices to secure reliable silver supplies, costs that ultimately flow through to consumers. The solar industry faces particularly acute pressure. Leading solar panel manufacturers in Europe and the United States have reported delays and increased costs, with some scaling back production targets for 2025. This comes at precisely the wrong moment, as governments worldwide have committed to aggressive renewable energy buildouts as part of climate commitments. India and Mexico, the world's second and first largest silver producers respectively, cannot easily fill the gap left by China. Mexican silver production has plateaued due to declining ore grades and insufficient investment in new mining projects. Indian production, while growing, is largely consumed domestically by the country's robust jewelry and industrial sectors. For investors focused on wealth preservation, China's silver strategy offers important signals. Beijing's accumulation of silver mirrors its well-documented gold buying, which has seen the People's Bank of China add over 400 tons to its official reserves since 2022, with actual purchases likely far higher. This strategic hoarding suggests Chinese policymakers anticipate continued currency volatility and potential financial system stress. Precious metals provide a hedge against both inflation and currency devaluation, concerns that have only intensified as global debt levels continue their relentless climb. The investment case for silver extends beyond simple supply-demand fundamentals. Silver's relatively small market, with total above-ground investment stocks of roughly 2 to 3 billion ounces, makes it vulnerable to price spikes when institutional money flows in. For context, the entire global silver market is valued at around $50–60 billion, smaller than the market capitalization of many individual large-cap technology companies. China's silver export restrictions fit within a broader pattern of resource nationalism and strategic decoupling between major economic blocs. Just as rare earth elements became a geopolitical flashpoint, silver is emerging as another critical resource that nations are reluctant to export freely. The United States and European Union have taken notice. Policy discussions in Washington and Brussels increasingly focus on securing critical mineral supply chains, with silver now included on these lists alongside lithium, cobalt, and rare earths. The U.S. Geological Survey has classified silver as a mineral commodity, critical to both economic and national security. Some analysts suggest that China's silver policy serves multiple objectives simultaneously, supporting domestic high-tech manufacturing, preparing for potential financial instability, and creating leverage in international negotiations. By controlling the flow of a critical industrial input, China gains influence over global supply chains far beyond its borders. Several scenarios could unfold over the coming years. In the optimistic case, higher silver prices eventually incentivize new mine development and increased recycling, gradually easing supply pressures. Primary silver mines take 7 to 10 years from discovery to production, but silver as a byproduct of copper, lead, and zinc mining could increase if those base metals see price rallies. Technological substitution offers another potential release valve. Researchers are exploring alternative materials for certain applications, though silver's unique properties make replacement difficult for critical uses. Solar panel manufacturers are developing designs that use less silver per panel, though these efficiency gains are partially offset by the sheer growth in panel production. The pessimistic scenario involves a prolonged supply crunch that constrains the renewable energy transition and forces painful economic adjustments. If silver prices spike above $50 or $60 per ounce, many marginal applications become economically unviable, potentially slowing the deployment of green technologies at a critical juncture for climate goals. A middle path seems most likely. Elevated silver prices in the 35 to 45 range that encourage conservation and substitution while making previously uneconomic deposits viable. This would represent a new equilibrium substantially higher than the $20-25 range that prevailed for most of the 2010s and early 2020s. For individual investors, the silver story presents both opportunities and risks. Physical silver, whether in coins or bars, offers direct exposure but comes with storage and liquidity considerations. Silver mining equities provide leveraged exposure to price movements but carry operational and geopolitical risks specific to individual companies and jurisdictions. Exchange-traded funds backed by physical silver offer a middle ground, providing price exposure without physical custody challenges. However, investors should verify that ETFs actually hold physical silver rather than paper derivatives, as genuine supply constraints could expose the difference between physical metal and financial claims. Timing remains challenging as silver markets are notoriously volatile. The metal often experiences sharp drawdowns even within longer-term bull markets. A long-term accumulation strategy, rather than attempting to time precise entry points, may prove more successful for most investors. Diversification remains crucial. While the case for higher silver prices appears compelling, concentrating too heavily in any single asset class carries risks. Silver should form part of a balanced portfolio rather than dominating it, perhaps 5 to 15% for those with strong convictions about the supply-demand thesis. China's silver export freeze represents more than a simple commodity story. It exemplifies the broader fragmentation of the global economy along geopolitical lines, with strategic resources increasingly viewed through a national security lens rather than purely economic terms. This shift has profound implications for the decades ahead. The post-1990 era of deepening globalization and ever more integrated supply chains appears to be reversing, replaced by a world of regional blocs, strategic stockpiling, and resource competition. Investors and policymakers alike must adapt to this new reality. Silver, humble and often overlooked compared to its monetary cousin gold, sits at the intersection of these mega trends: the energy transition, great power competition, technological advancement, and monetary instability. What happens in the silver market over the next several years may serve as a bellwether for how these forces play out across the broader economy. The quiet reshaping of global silver markets by China's export restrictions deserves far more attention than it has received. This isn't simply a story about metal prices. It's about the changing architecture of the global economy and the fragility of supply chains that modern civilization depends upon. For those with eyes to see, the silver market is sending clear signals about resource scarcity, geopolitical friction, and the challenges of transitioning to new energy systems. Whether as an investment, an industrial input, or a monetary metal, silver's role in the global economy is expanding precisely as its availability faces unprecedented constraints. The wealth implications extend beyond simple price appreciation. Understanding resource flows and strategic accumulation patterns offers insight into how major powers view future economic and geopolitical landscapes. China's actions in the silver market, like its gold purchases and rare earth policies, deserve close attention from anyone seeking to preserve and grow wealth in an increasingly turbulent world. As we move deeper into 2025 and beyond, the silver story will likely intensify. Supply deficits are not easily resolved, industrial demand continues accelerating, and geopolitical fragmentation shows no signs of reversing. For investors willing to look beyond conventional narratives, silver offers a compelling, if volatile, opportunity to participate in one of the most significant resource shifts of our time.